Traders, welcome back to the final part of the 4-part series of selling short puts. Today we're going to be going over how to calculate the return on margin so we can calculate how much return we're actually making on our trades. We're going to be talking about cover calls if you get assigned on your shares of stocks. It's going to be a very interesting strategy. And also we're going to talk about the risk considerations because there is no free lunch in anything. Even though this strategy is very nice, there are risks that we need to consider, and I will be addressing them. So let's talk about the return on this strategy. Since we're not investing money up front like buying stocks, we will be calculating the returns based on the margin usage. And the margin usage will be much lower than the cash required for buying a stock. Let's go ahead and start with an example of how we'll calculate the returns. If we were to look at the 85 strike put for Disney, DIS, 43 days, we will collect $1.25 per share. So we'll collect $125 in premiums. The margin cost of this contract is only $993. So let's just call it $1,000, for example. Now this is a lot less than buying the shares outright, because if you were to buy one lot of 85 strike, that will cost you 85 times 100. That will cost you $8,500. But if we're using margin, just to open this short put contract, it will cost you almost 8 times less, and it's only going to cost you $993. So if we divide by $125 the premium that we make by $993, it is 12.59% of return on margin in 43 days. That's amazing, because if you were to calculate it on an annual basis, that's over 106% return on margin. Where else can you find a strategy that will return you 100-something% return on margin while your win rate is near 90%? That's amazing. Okay. Now, most of these trades are actually shorter than the DTE, the days to expiry. So in our previous example, 43 days, usually you'll hit your profit target and you'll close it out way before 43 days. So you can actually reopen more and you can compound the gains even further. So we're looking at higher than just 12.59 in 43 days, way higher than that. You might get that 12% in maybe 30 days or so already. Okay. Now, there is some risk associated to this because it's so efficient to trade on margin that a lot of beginner traders, I repeat, a lot of beginner traders often overtrade, and that is a huge problem. So what we're going to be doing is I'm going to talk a little bit about the sizing and what you should be doing. Okay? So how can we not overtrade? We're going to use max 5% of the net liquidity per position. Okay, so what that means is if your account is 100,000, 5% of that is 5K, 5,000. You're only going to use a max 5,000 of margin per position. So in our example of Disney 85 strike, that costs us 1,000 in margin per position. So the max amount of Disney 85 put contracts you would open is 5 of them. Only 5 positions. Okay, this will keep your margin usage safe and balanced. It will keep you in a safe and sweet spot between risk and reward, and not oversizing and not overtrading. Now we're going to jump to another topic. It's going to be totally different. This is another bonus that I want to talk about. I want to give you guys a feel of what you guys can do when you're assigned. And now that you own the stock, what should you do with the stock? So, of course, you can simply sell the stocks and get rid of it. Okay, but say the stocks went down, further down than your assignment price, then maybe you want to hold it for a little bit. But while you hold it, you want to collect some premiums. Just think of it as dividends. You want to do something. You want to exercise your capital while you wait for it to get called away, while you wait for it to go back up until you sell it. So we can do something called covered calls. You can sell calls. This is the opposite of the puts, okay? We can sell calls against your 100 shares of stock to collect premium while we wait. Okay? So what is selling a call? Let's read the definition first. The seller of the call is obligated to sell the stock at the strike price if somebody exercises or it expires in the money. In layman's term, what this means is this is another way to sell a stock at a pre-planned strike price while we collect premiums. Let's go over an example of math with some numbers. Say we were shorting a put and we short the 100 put, okay? And we got assigned the stock at 100 because the stock ended up at, say, maybe $98 on expiry. The stock is at like $98. And we were forced to buy the stock at $100. So you're losing $200 right now, okay? And you don't want to sell the share at $98 to realize a $2 loss. So what we're gonna do is, we're gonna say, let's sell the stock when it hits 105 instead. So we're gonna sell the 105 calls and we're gonna collect premium on it too. So you're getting paid to say, I promise to sell the stocks at 105 if the price is above then. Okay, so we're gonna do that and we wait, okay? And while we wait, the stock does go up to 106 on expiry. Because you promised to sell the stock at 105 on expiry, this is how much you'll make in total. So you're selling at 105, you bought the stock at $100, so you're making $5 right here per share. And then you collected $4 in premium too per share. So that's $9 per share. And you have 100 shares, so you make $900. Let that sink in for a little bit. Isn't that amazing? You just had to promise somebody you sell your shares at a higher price, and not only you make money from selling at a higher price, but you also make money from the premiums. I'm gonna be making another video that will go in deeper details of how to play this cover call strategy. But I just wanted to give you guys a sneak peek and a little taste of it is not the end of the world when you get assigned. It's actually a great thing. This is an excellent strategy, and for sure I'll be making a video on it. So I'm going to be jumping into the final part of the video, which is talking about the risk considerations. Okay, the first risk we have to be aware of is not all stocks are good. And if you take assignment on the stock, which means you get assigned, which means you buy the stock can go to zero. That's why it is extremely important for us to not play with any garbage stocks. We want to play with, remember I told you in part 1, we want to choose good high quality stocks such as ones on the SP 500, on the various indexes, okay? We're not playing any Wall Street bets, any new IPO with high IV. That is not our goal. We want to play with good stocks. And you can see even with Disney, these boring stocks, we can get almost 100% return on margin a year already. So there's no need to go play with garbage high IV stocks that will make you maybe 1,000% a year instead. That's not the goal. When you're making 1,000% a year, it might work for a little bit, but there's a big chance that you're gonna blow up. One of them's actually gonna go to zero, and it's extremely dangerous. The second risk and consideration I wanna talk about is you may see paper losses during the trade, okay? Do not panic. Ignore the 300%, 400%, 500%. Okay, that's the paper loss is not important. Remember the basics and the math of how short put works. Okay, in this kind of trade, we don't look at the P&L percentage. Stick with your rules. We only exit based on technical analysis. Maybe you use support and resistance zones, etc. But we're not going to be exiting because you see a negative 300% right there. Okay, you might exit based on 21 days to expiry or any other rules you set in place. Okay. And I want to mention, at any time during the trade, if you want to exit for whatever reason, you can always buy back the option anytime before expiration. You don't have to wait until the expiration date or it hits 0 days to expiration. You don't need to. If you feel like you made a mistake, you open the short put, you can actually close it right away. Option contracts are traded just like a stock. You can buy and sell it. It's very liquid, and that's why we have to choose liquid options, because if you want to exit, you want it to buy it back from somebody, right? And if there's no liquidity, you might get a big bid-ask spread and you won't get a good fill, and you might lose money that way. But if you have a tight spread, you can enter and exit with very minimal slippage. You'll just lose maybe a few dollars. All right, traders, that's it for the short put series. I hope you guys enjoyed it. It was a very long 4-part series. Make sure you guys rewatch any part that you don't understand. This is one of the most powerful strategies out there in the options world. Every professional option traders have this in their arsenal. So give it a try, study this material well, and I hope you guys will enjoy this strategy as much as I do. I hope it can be part of your daily option strategy. And as always, if you have any questions, you can post it in the comments and I'll try to answer them as soon as possible. Traders, trade small, trade safe.